Good morning, India. Happy New Year. First rates 2024. And there you go. First rates of 2024 after a gangbuster 2023. It's a red tick, or I would say it's a flat tick. The first rates, I think the bulls are also taking some time to warm up. And, the warm up sometimes takes time. 2023 has been a sprint. It's been more like a 100-meter dash in small and mid-cap stocks in the last couple of weeks. Mid-cap index is off to a good start. The market breadth is looking promising once again. And in terms of the broader assortment of the market, I think autos is where you will see some news-based action. Let's look at the linear movers of 2024, 2023. Are they starting off to a good start for 2024 as well? Which includes names like Tata Motors, NTPC, stocks where the move has been linear. 20% is what the index did for the year gone by, 50% plus is what the small cap index did, 40% plus is what the mid cap index did. I mean, these numbers are not going to repeat themselves. So if luck paid money in 2024, I think it really could be skill, which will be the differentiating factor.
Yes, skill is what you will definitely need, but the advance decline ratio for now is very, very healthy. Almost 1,500 stocks advancing to 300 declining. It's pharma which is starting on the front foot. So Glaxo, Gland, Dr. Reddy's, these are some of the names to watch out for. And for now, at least the PSU banks are continuing their bull run. So Bank of India, Central Bank, these are some of the names. Though the heavyweights, the likes of Axis Bank, Kotak Bank, ICICI Bank, HDFC, these are the rank underperformers, and these are the names which is actually dragging the Bank Nifty lower. It's not a great start for the Bank Nifty today. Talking about individual names, as we are pointing out, BHEL merits attention. There's a 5% surge on that stock. Large trade also happened in terms of the stocks that changed hand, and that is on account of that Talabira order of 19,400 crore that is in focus. You also have Jubilant Life higher by 6%. Realtel Corp on account of an order win is higher. Inox Wind is the other one, and Jyoti Labs, Captain Points. These are some of the other names which have started with good gains. On the losing side, Safari Industries, Cholamandalam, Sonata Software, Kalpataru Power. These are some of the names which are seeing some amount of profit booking. From the broader markets, I also wanted to see what Kaveri Seeds is up to, what a KPI Energy is doing, because these are stocks in focus on account of news flows. So yes, Kaveri is higher by 7%, though KPI Green is down about in the trading session. So not big individual movers, but yes, it's the market which is doing quite well. You have the advanced decline ratio at around 1,500. But time now to take the first trades from Kunal as well as Naresh. So Kunal, what's the first trade?
Well, we'll still look at large cap names. HDFC Bank could be the stock, which I think at 1700, 1710 mark looks attractive for a fresh opening trade.
And Naresh, what's your first trade for today?
So that would be a buy on Maruti, which is at a good price point for risk reward. So expecting a bounce here.
Pleasure to bring on board S. Naren, Executive Director and CIO with ICICI Prudential AMC, to talk about markets, returns, some ideas how to make money, and what is keeping him busy these days, apart from just tracking funds and NAVs. Naren, fantastic to have you on ET Now. Happy New Year on behalf of everyone from Team ET Now to your team and to everyone at back home.
Wishing you and everyone, every viewer, a very, very happy and healthy and prosperous 2024.
Naren, 2023 was a record year. Small cap, mid cap, large cap, gold, bond market, Bitcoin, just about everything gave stellar returns. How much of 2003 frenzy is likely to extend itself in 2024?
It's tough. What we are happy about is that we manage other people's money, and the money is collected at various points of time. When we launched NFOs in 2021 and 22, like FlexiCap, Business Cycle, PSU, Transportation, Housing, many of us used to tell us, are you not launching at an inappropriate time? And it is such a happy feeling to see that each one of the NFO investors are a happy lot these days. But going forward, it's very challenging. So it's very easy to tell the old investors, you are happy investors, stay invested. But what to do with the new savings and what to do with new money if you want to allocate is a very big challenge for investors. Having seen markets for a long period of time, what we've seen is the worst mistakes are made in big bull markets by investors, by mutual fund distributors, by fund managers. whether it is in 1992, 94, 99, 2007, etc. So when we went back at ICICI and looked at what was the way to avoid the mistakes, what we found was asset allocation is the only way to reduce the mistakes. And that is what we are telling people at this point of time. Because if you had practiced asset allocation in 2007, the mistakes would have been much, much lower. If you had practiced asset allocation in 1994, the mistakes would have been much, much lower. And that is the lesson which we have seen in bull market, which works very, very well. And today we are clearly in a bull market if you look at the period from 2020 to 2024. So that's the simple mantra which seems to have worked in all boom markets, and that's what we are recommending to all the people at this point of time.
So when you say asset allocation, Naren, let's spend some time discussing that. Is it time to, let's say, take 15-20% money of equities in general, or 15-20% money from small and mid cap to large cap?
I think when we look at the market, see, India has been managed brilliantly macroeconomically. It is a fantastic structural market for the long term. So if you look at the old money that has been invested, let's say in 2020 and 21, we expect markets to go back to where it was in 2020 or 21, very unlikely. So I think it is more important if you look at the history of bull markets, the mistakes have been made by people who invested the money in 2007 or 1994 or 1999. So we are much more focused on the fact that new money should be invested more carefully than taking out old money. So I think that keeping the old money is much more comfortable, and you can just stay invested in that because it looks with the way brilliantly macroeconomically India has been managed. And India being such a fantastic structural story, markets can correct, but I don't think we are going to see 2020 markets or 2021 market levels easily. So staying invested in the old money is a very, very easy thing to do. It is it is the new money where we are telling people be careful and invest carefully. Don't invest only in pure equity. Invest in across asset classes. Because if you invest only in pure equity and you say I'm going to invest in small cap after a 3-year 40% CAGR, then the risk is higher. So invest in all the asset classes, invest in debt also through hybrid strategies, and that's what we're telling people. But as far as old money is concerned, let it run. If you had asked people 1 year back, would this return have come? No one would have guessed it, including us. I don't think we expected this kind of return in small caps or mid caps in the 1 year back. And that is the reality.
Still SIPs in small and mid cap schemes. I'm asking you very basic questions, Naren, because it's time when you really need to think about your portfolio and say, okay, I've had a great year now. How do I preserve capital?
So even in Diwali, people asked us this question: what should one do? And we've been telling people incrementally, you have to invest money in large cap or flexi cap. And there is no case, in our opinion, to invest in small cap and mid cap. Actually, from Diwali till now, large caps have done pretty well, including mega caps. And at that point of time, some of the mega caps had done very badly. And suddenly now, some of the top 2 mega caps and all have done very well at this point of time. So we continue to think mega caps over small cap and mid cap. Is there a case to do some kind of a systematic withdrawal in small cap and mid cap? Maybe, but is it easy to do what we once my colleagues in PMS did in 2018, take out the money wholesale in small cap? It's very tough at this point of time because we are in a very, very structural bull market. And it's in a situation where the other emerging markets are completely discredited. So it's a very tough call to say you take out all your money at this point of time in small cap and then the market goes up and then you'll feel like reinvesting. That's a very tough call. Whereas it is much easier to say you do a small systematic withdrawal plan. That is certainly possible, but not a wholesale withdrawal. And that's very difficult for us at this point of time, given the fantastic way in which macro has been handled, given the fantastic way in which you see a long-term structural story. So you have to be careful in investing incremental money, but to take out all the old money at one go is a very big challenge at this point.
Naren, let's talk about valuations. The ultimate benchmark of future returns is a function of earnings, and the current set of valuations.
Yes.
Where in the market do you think right now markets are fairly priced, they are richly priced, and which end of the market is reaching what could be called as a frenzy level?
Where it seems to be fairly priced is clearly mega caps at this point of time. Where it seems to be fairly priced is clearly, if you ask me, banks at this point of time. These are areas where it seems to be fairly priced at this point of time. If you look at most portfolios, they are underweight the mega caps, they are underweight even the banks at this point of time. They may be the largest part of the portfolio, but people are today underweight banks. Clearly, I would say where valuations seem to be very high seems to be in most of the small caps at this point of time. It will be very surprising for you to hear from us that some of the PSUs look overvalued at this point of time. 3 years back, when we used to meet some of the PSUs, we used to tell them, "You are the best managed companies. Why are you so cheap?" And some of the PSU MDs used to tell us, "You tell us what we should do." We used to tell them markets always function in cycles. You don't need to do anything. You will find surprisingly at some point of time in future, because of the good work that you've done, your stocks will become costlier. And even we could not have imagined in the next 3 years, the PSUs have moved from being one of the cheapest segments to the market to a situation where some of the PSUs are today overvalued. And it is because of the good work done by some of the PSU managements, the way some of the government has also ensured that the PSUs have worked in the interest of the shareholders. But that's a funny thing. In 3 years, they have moved from undervaluation to selective overvaluation in some of the PSUs. And that's very interesting because it is due to the good work of the government actually. And these are the segments which look at this point of time as overvalued. Now, one of the lessons we learned from our FMCG experience is markets can be overvalued for quite some time. We used to think that FMCG overvaluation is there long back. Now they have underperformed significantly. But for a long time, the overvaluation stayed. So just because we at ICICI believe a sector or a theme is overvalued, doesn't mean that that theme will correct just because we want it to underperform. That's what we have learned over a period of time. But these are the themes which look overvalued.
Then PSU is a very large basket. It starts from defense, there is railway, there are metal, there are banks, and each sector is a different play per se. When you say PSUs are looking expensive, which end are you referring to?
No, obviously, you are obviously, whether it is in small cap, mid cap, or PSUs, it is difficult to say which segment. I mean, the conventional, you can use some conventional metric. You can look at some of the price to book. You can look some of them on price to earnings. You will know which are the stocks which are overvalued by just looking at the price to earnings and price to book. And it is difficult for me to talk on specific stocks because, even sectors, some of the sectors are, it is built. If you look at the implied valuations which are there in some of the stocks, in some of the small caps, for example, they are all inbuilding a lot of things at this point of time. And that is why it is difficult for me to point out individually. But if you look at the index, for example, the PSC index, clearly we have been much more positive on power within the PSU theme than other areas because we felt that the power generating areas are still more reasonably valued compared to the other areas. And we have been more positive on the upstream areas in the PSU theme because these were the two themes where the price to earnings was much more reasonable than many of the other PSUs. But if you look at the price to earnings of many of these things, and in some of the cases, the price to book in some of the areas, they are not being cheap at this point in time. But I must compliment the managements in many of these companies. And I must compliment the government for actually working in making these much more valued at this point of time.
First a macro question, then I'll come to some trends. There are three moving parts which I can see, and you can add maybe 4 or 5 if you want to this list. And the list is next year, what China will do, will Fed cut rates, and the impact of election volatility. These are three big moving parts which could be binary in nature. How do you view these moving parts for next year? Which to your mind could be the biggest moving part?
China is one of the very, very cheap markets in the world, but no one is able to understand China. I mean, I thought it was cheap and it deserved a contrarian position, but it turned out to be wrong because no one can understand China. If anyone visits China and comes back, they come back depressed. So I don't, maybe we have to accept that it is impossible to understand China because it is not a capitalistic society and it is run in a very different way from a democracy like India. So maybe that's where it is. As far as Fed is concerned, see, we have to remember that as far as inflation is concerned, we seem to have clearly seen the peak and it is coming down. But there are other things we have to remember that if you look at US as a country, the fiscal deficit is just shot up through the roof. And despite huge oil production, the current account deficit is not coming down. So I'm not able to understand how can you have such a high fiscal deficit in the most advanced economy in the world, and the fiscal deficit is not at all low. So when you have such a high fiscal deficit and such a high current account deficit, will the central bank only look at inflation coming down and not bother about anything else because they have to fund their fiscal deficit as well? And this is something that we think about, but that's not a that is not a emerging market central bank. That is the central bank of the reserve currency of the world. So maybe we'll have to think differently, and that is where we are looking at. What was your third point? I just missed. Sorry.
That's also a big volatile. I mean, there are not just local elections. There are 40 elections next year
Yeah,
across
yeah.
the world.
Election will be a source of volatility, and in some other countries, people may get it wrong, and that will be a source of volatility. And that can't be helped actually because as we have seen repeatedly over the years, people think that the financial center people can predict elections actually, and financial markets can understand elections. Financial center people have no knowledge of political matters. They don't even get markets right many of the times. Where will they get politics right? That is how we look at it. So they can possibly understand valuations, they can understand sentiment, and maybe they can understand cycle. But getting market trends right always and getting political trends right always is impossible. And as you know, we never expected Ukraine. We never expected what will happen in the Gulf region or Hamas or something like that. So sometimes we overrate our ability to understand geopolitical issues. Not sometimes, always.
We live in an uncertain world where nobody knows the future. We're just trying to understand markets through the lens of probability. So Naren, my next question is about these popular themes: EV, manufacturing, energy transition. Are you taking a bet in any of the popular themes: EV, manufacturing, or energy transition?
So if you look at EV, we bet normally on the companies which we like, and we have bet in our own way on some of the EV companies very early on. And as usual, I have to thank some of my younger colleagues, for thinking of these things at the right time and the right sizing. And, those bets have gone off very, very well for us as a company in the auto side. And, as investors, that too managing other people's money, we are very conscious that we will not bet on companies which have huge losses. So we love a company where, there is a profitable business. Along with that, there is an unprofitable EV business. And that unprofitable EV business is also given price to earnings on that on the loss. So that at some point of time, when that EV business turns around, you get a big kicker, and that is a framework which we enjoy. Like for example, we did the same thing in a pharma company where there was a specialty business which was incurring a loss, on which a multiple was given on the loss made, whereas we knew that over a period of time the specialty business will turn around and that will give a benefit. And that framework is what we have used because we have the benefit of patience and we have the benefit of long-term thinking thanks to the investors who will give us money for the long term. So with that process, we have actually focused and we've had a good experience in EV. As far as manufacturing, we've been people who have had a manufacturing fund, and frankly, my colleague who runs the manufacturing fund has been recommending consistently to the distributors to get money there, and the fund has actually been scaling up. Having said that, both me and my colleague have the same view that in services we have leadership, which is very, very easy. Whereas in manufacturing, the leadership is not straightforward, and we have a lot of work to do there. And the kind of leadership we have in services, no one can compare with us. Whereas in manufacturing, every country competes with us. And that is why the manufacturing leadership, as far as the country goes, is not as easy as the services leadership that we have. And that is why I believe that it is going to, the sector has already done extremely well. And from here on, whatever valuation challenges which are there in the rest of the market apply to this scheme as well at this point. And that is what we look at it. And on energy transition, actually, at some point of time, we felt that the transition people were thinking of was going to happen too fast. And we actually bet on the reverse by betting on areas like thermal power and all that. And that worked out. Now we have to look at it the other way and see whether people are over-focused and thinking that, energy transition won't happen. And we have to now look at it the other way. So I think 3 years back, by being contrarian, we benefited. Now, should we be contrarian and think that actually energy transition worries people have forgotten? We have to think. But, in India, it's so, if you look at it, one of my colleagues actually bet on many of the wind energy companies. And that turned out to be a very good decision in recent times. But the challenge in energy transition is the wind companies and all that are much smaller, and the scale of the money that we manage and the amount of money that can be put into energy transition companies is not tallying with what we can invest as a large AMC. So that is the challenge we are having from a AMC point of view at this point.
Street is split right in the middle on IT. The AI believers think that this is a disruptive, and Indian IT services per se, the model will get changed. The folks who've seen 15, 20 years of evolution, they are of the view that, look, when Y2K was changing, the same issue was discussed. When enterprise was discussing, the same issue was discussed, but the Indian companies have migrated beautifully. What is your view?
I think the Indian IT companies are brilliant companies. They have very good governance and ability to transform themselves. But I think more than the AI issue, I feel, what has happened is India has become such a brilliant services hub that almost everyone has set up a GCC. Along with the AI risk, our view is that the GCC setting up has also reduced the growth rate of Indian IT. And it is not that the Indian IT companies are doing badly. It is just that, India has become such a hub that there's no one who doesn't want to set up a GCC. And GCC reducing the growth has become a problem, I think, also. And so it is the combination of GCC plus AI. AI trend has not yet shown up in our opinion and may show up over the next 3 to 5 years. It is the GCC reducing the growth which has already shown up at this point of time. And that is what worries us from a valuation angle, from a company angle, from a governance angle, from the way they have given back money back to the shareholders. I think we are deeply happy with the Indian IT services companies. But the growth rate of the Indian IT services companies in the recent past has not been good and not in line with the valuations. And that is a function of GCC now.
You follow Harvard Marx and you're a practitioner of greed and fear. And markets seldom get into this greed zone and seldom get into fear zone. Now, there is no fear in the market, but there is a lot of greed in the market. So how are you navigating that feature of the market?
That is the problem. That is why when we tell people and we meet people, there are asset classes other than equity. That's why you should consider today new money in hybrid. For example, I am not involved in this business, but there are AIFs which are focused on debt. People laugh at us. What is this debt as an asset class in AIF and things like that? I'm not involved in that business, luckily. They're almost laughing at them. So we have a credit fund in the AIF space. Logically, people should put money in those spaces, but people just don't even consider them. And I find it absolutely clear that, the greed is so high towards equity-oriented products that people are not willing to consider those products at this point of time. And I find it really interesting that the greed is so much towards equity. And we have seen that, when you have an asset class, which have done well for 10, 11 years. And equity from 2013 to 2024. And we've seen that in real estate from 2003 to 2002 to 2013. People think all the other asset classes are not worth it. And that is the phase right now in the asset markets today and that is the reason people are not willing to look at other assets. So what we do as an AMC, and thanks to the good work done by all the people around me, is that we focus on hybrid and focus on all the categories in hybrid, whether it is multi-asset or equity and debt or balanced advantage or equity savings. And my colleagues, and I'm not involved in that business, focus on things like debt. We say, no, we will not give up on the other asset classes. And it's a tough task because the unit output that you get for unit input is much lower in these things. Whereas if you decide that you will sell only pure equity, the output will be much higher because the output is much higher because people want to invest only in equity at this point in time. Whereas we are the people who are saying, no, don't do that. There's too much greed in equity. There is too much disinterest in every other asset class. So focus on that. But we will do it because our learnings and we manage other people's money. And by focusing on greed and fear, it has helped us over the long periods. So we will continue to do this irrespective of the output being lower than the input. We will continue to do this.
Naren, correct me if my interpretation is wrong. You are of the view that, look, we are not in the green zone when it comes to buying. We are not in the yellow zone when it comes to fair value. We are perhaps bordering the red line. So markets go up by another 5-7% in a hurry only because of liquidity. Would you raise the red flag then? Would you come on the channel and say, okay, it's time to take significant amount of profits away from equities?
We're closer to that. I think you put it correctly, but it's a very tough task to come on your channel and give that call. But I would say that investors have to practice asset allocation. And I believe that, 7 to 10% from here, if it happens in the next 3 to 6 months, I think the markets will be fully or overvalued. That is how it looks at this point of time. And at that point of time, clearly that is what it looks. But it is a very tough task, to do that because, how much momentum goes up in the last phase of the market is impossible for anyone in ICICI to predict. In fact, I did a short presentation to my team showing what happened in the last 6 months of 99-2000 and what happened in the last 6 months of 2007-8. And my colleagues were astounded by the return shown in the last 6 months of those bull markets. So it's a very tough task to do what it is. But clearly at that point of time, we will not be cheerleaders for the market. Maybe we'll hide in the market, hide away, and we will not tell people to definitely invest aggressively. But that I'm very sure about. But to give a sell call, because you look at the last 6 months of the 99-2000 bull market and the last 6 months of the 2007-8 bull market, the market just shot up far beyond fair value. And that is the challenge. But even today, we would tell people that if you're investing for the long term and not the short term, you should practice asset allocation. And that is what we've been telling you.
Naren, really appreciate your time and so glad you could join us. And Naren, I'll urge you to stay with us because you may want to hear Mr. Dinesh Kumar Khara, India's biggest banker. And when he joins us, all the world takes a notice. And what a great way for us to start a year with none other than the chairman of SBI himself. Mr. Khara, good morning. Thank you for joining us. We managed to, sir, get you on camera. I hope it was not a late night for you, but it's been an early morning for you for sure.
Thank you very much, Nikunj. I'm an early morning riser, so that's no challenge.
So should we start with New Year resolutions?
Yeah, New Year resolution is to continue to improve upon where we left the year 2023.
Sir, that's SBI New Year resolution. What about your New Year resolution?
Even my resolution is also in sync with what the SBI resolution is.
And you think that will happen in 2024? Because incrementally, Mr. Khara, with each passing quarter, SBI has managed to move from strength to strength.
Yeah, I do agree. And this will be our endeavor going forward too.
Mr. Khara, when you look at the demand versus credit growth, last time when we spoke to you, You are confident but conservative. What is your assessment of demand plus credit growth for FY24 for remaining part?
Well, I expect that the kind of a GDP growth numbers which we have seen in the first half of the current financial year, and if we add the inflation component on that, so it works about to be about 12-13%. So normally we have been seeing that we are growing about 1 to 2% more than what the growth rate in the GDP is, nominal growth rate. So I expect that around 14-15% growth is something which we expect within the bank. So we are on track for that, and hopefully we'll get to see these growth numbers at the end of the financial year too.
You've managed to turn a difficult number, which is ROA. Sub 1% has now become a permanent 1% plus. 1.2 to 1.3 is what markets are expecting would be the new normal for SBI. Will markets get it right?
Hopefully, yes. We are, in fact, for last more than 3 quarters plus, we have shown actually it has been our last quarter we had seen 1.10. So I hope that we should be moving towards the trajectory of 1.20 as far as the ROA of the bank is concerned. There is a conscious effort, and all endeavors are in that direction, and hopefully we'll get to see those numbers also.
Mr. Khara, what messaging do you think we are getting from the regulator? Because the regulator now clearly seems to be sending a message that, okay, this is, you got to watch out when it comes to the unsecured loan. They are really looking at tightening that space. Do you think we need to be worried about unsecured loan as a category now?
I think the regulator was very clear in their mind when they have increased the RWAs for the unsecured loan. But while doing so, they were looking at the general trajectory in the unsecured loan space in the banking sector and also the NBFC sector. So, though at a macro level, perhaps the growth was too high for the unsecured loan piece. But when it comes to bank in particular, particularly State Bank of India, we had already calibrated our growth in the unsecured piece. And on the top of it, the quality of the unsecured in our case is much better. I would say that it's more like a gold standard, touch wood. And we hope to maintain this quality, and we don't envisage any challenge in as far as our unsecured book is concerned. But yes, of course, with the increased RWAs for unsecured loan as well as for lending to NBFCs, some of the NBFCs, there would be a situation where the cost of funds of such NBFCs will go up. But nevertheless, when it comes to housing finance companies, gold loan, etc. So those are the companies where it does not really go up. So they would be in a better position to avail the credit at the cheaper rates, and they will continue to fuel the growth of the real estate in the economy.
Mr. Khara, also another important move from the regulator is to increase the DA-SIB capital requirement for SBI and HDFC Bank. In the light of the fact that they are important banks, how should one read into it?
Well, I think it is a step which has been taken overall by the regulator, considering the kind of risk which they are perceiving in the economy. And also they would like to have the buffers created. So with that in mind, it has been stipulated, but it is effective from 1st of April 25. That is what the prescription is. So I'm quite confident that with the kind of clawback which we have, we will be in a position to generate adequate clawback to take care of this increased capital requirements which have been prescribed by RBI. But we are very closely watching whatever is the situation, and we will be ensuring that the bank should be very well capitalized. It is already well capitalized, but it should stay well capitalized and meet all the regulatory requirements. Because RBI prescription is one, our board prescription is invariably over and above that. So we have been always adhering to the board prescription, and will stay well capitalized to take care of the regulatory concerns relating to some kind of risk which they are perceiving building up in the economy, and more so at, I would say, it is more coming from the global economy point of view.
Mr. Kara, just to go back to that whole point on unsecured loan, you mentioned that there are no red flags for SBI when it comes to the quality of the loan. But would you be consciously looking at slowing down the unsecured loan?
Well, we earlier we were also growing fast, but now we are in the unsecured piece. We are growing at about 18% or so. So I think it is still doing well as compared to many other subsegments of the of our book. So I think we would be see the natural demand for the unsecured loan which is there in our book. We're in a position to meet out, which I expect to be somewhere around 18 to 20%.
When we spoke to you last time, Mr. Kara, you were of the view that new areas like EV, energy transition, renewables, these were the high growth areas for SBI. What is the update on that?
No, that continues to be the major focus area. The renewable continues to be the major focus area, and we continue to see the proposal coming in into this particular subsegment. And similarly, when it comes to EV, battery storage, data centers, and these are the areas where we are seeing good interest from various entrepreneurs. And we expect that we'll get to see a decent demand in this particular segment too. Even for that matter, logistics, warehousing, etc. There is a demand which is seen. And I would say that apart from the core infrastructure where the initiative which was taken by Government of India is already yielding results. In addition to that, these are the other areas where we are seeing the demand. And I would say that some bit of a global supply chain balancing in terms of electronics and engineering goods also, we are seeing those capacities also getting added in the economy. So that's the broad picture, which I would say as far as the corporate loan book is concerned.
Just to get the cycle right, Mr. Kara, your words are something which markets will take notice of. What you've guided for, sir, is the FY24 credit growth guidance. Now that is 3 months away. And now markets will start talking about FY24, 25 and 26. Do you see the current credit cycle sustaining for at least 3 to 5 years with very low NPAs?
See, this will be the function of how the real economy performs and the kind of growth trajectory which is being talked about for the real economy. That is quite encouraging. And in the backdrop of the real economy growth, I perceive that it would be a decent opportunity for the banking system also to grow.
I think beyond FY24, the base effect would kick in and you would be slowing down. You don't see that happening?
If at all GDP grows at about 8% or so, then perhaps I would say that this would be the kind of growth which we should get to see. The kind of numbers which will be clocking this year, we expect the repeat of the same, but once we approach nearer to the actual time period, then perhaps we'll be having a better visibility.
And if I look at your numbers, assuming that you will grow at nominal GDP plus 1 to 2%, looks like for FY25 also your capital requirement would be zero. You'll not come to the market for next 18 months at least?
That's the ideal situation. But yes, of course, we'll be evaluating the scenario, and based upon that, we'll be taking appropriate calls.
Numbers here, sir. I mean, your last year's profit and projected profit, if you plow back that, and if I add back your credit growth, I think you don't need money for next 18 months at least.
That's the model which we want to practice, because ideally speaking, for a bank of this size, and also the considering the profits which we're generating, that is the best source for us to capitalize the growth.
It's so heartening to see how PSU banks have made a comeback. And this is not once upon a time. 5-6 years ago, PSU banks were recapitalized. They were recapitalized at prices, not SBI, but other PSU banks at levels which were sub-book. And today, banks and PSU banks and some of your peers are actually going and raising money via the QIP route. What has changed, Mr. Kara? I mean, why things have really changed for the PSU sector per se, especially PSU banking sector?
Well, I think there are a couple of things. The PSU banks had always they had a balance sheet which was heavy in terms of the corporate loan book. And as far as the corporate loan book is concerned, the ecosystem changes which took place in terms of IBC and also in terms of the responsible borrowing which we witnessed, and also ability to resolve some of the impaired assets. That is something which I believe has changed the perception about the PSU bank and also has put in place the business models which are quite robust. So I would say that because if at all they have strengthened their risk quite a lot, risk management practices, underwriting standards. So if at all, a bank has got a loan book which is performing well, I think when it comes to the revenue stream, this is the most stable revenue stream which the banks have. If at all they are not required to provide for, perhaps this is the best of the situation. So I would say that what we have seen today is essentially a culmination of various efforts which were taken by the government, by the regulator, and by the banks also in terms of strengthening of their risk management practices. The net result of this combined effort is seen in the performance of the public sector banks today.
Mr. Khara, just when it appeared that interest rates globally and locally have topped out and things were looking up and the war for liability is over, SBI has actually increased deposit rates in some categories. Is it specifically to some category or the war on liability is not over?
No. It is actually we were looking at our the interest rate curves. So when we looked at it, we thought that there is a need to smoothen the rate curve to spread the maturity profile of the deposit from the ALM perspective. And these are some of the areas where we felt that there's a need and we did that.
The war of liability, which everyone spoke about, which was the story for 2022 and 23, that's over for the sector?
Sorry, I missed out your question.
The war of liability, sir, where
No, I think I would say that some of the banks have got very high credit deposit ratios. So for them, I'm sure they would be liability will continue to be a major focus. But yes, of course, the market has also witnessed, as Naren was rightly mentioning, that it's a time when people should look at asset allocation. So similarly, when it comes to liabilities in the banking system, there are alternate options which are available. And invariably, we have seen that when the markets do well, there is a natural attraction of investing into the markets to either through mutual fund or directly. But I would say that it is essentially the asset allocation, and that principle holds good. So that is one of the reasons why perhaps we have seen the kind of a situation as far as the liability, fight for liability was concerned. And apart from that, we have invariably seen that during inflationary conditions, there's a tendency on the part of the depositors to look for asset class which can fetch them better. So that is the other reason which we cannot ignore. So these are one has to operate in the overall macro situation, and I think in that the business practices will differ from scenario to scenario.
Mr. Khara, you've taken the internal productivity of SBI to a different level. ROA has gone up, credit growth has been fantastic, the lending mechanisms are really in place. But market share, SBI has always been between 20 to 25% market share. And that has happened in ordinary years. These are great years for SBI. What is your plan in place to gain SBI's market share? Gain from others, दूसरों से?
Well, I think we actually look at it from the perspective that we are looking for the risk which is in line with our risk appetite. So that is something which we always keep in mind. And with that, whatever opportunity is available, we'll certainly like to tap that opportunity and will grow. So, and similarly, when it comes to liability side also, we have we take advantage of our reach. We come out. We have focused on the customer experience, and we believe that our ability to offer a much better customer experience also helps us in gaining the mind share of the customers, which eventually helps us in having the market share too.
Mr. Khara, in this cycle, in this new credit cycle, do you see PSU banks doing much better than private banks, largely because they are lending aggressively in infrastructure, they are lending to build new India, and private banks have been very conservative. They're still focusing on their retail account, they're still focusing on HNI, they're still focusing on fee-based income.
Well, I think the economy offers opportunities in all the subsegments. So, but as I mentioned, that each of the bank will have to decide their own niche area or the risk appetite, and based upon that, they invariably build up the skill set also in line with the risk appetite. And once they have built up those kind of skill sets, they can exploit the market opportunities. So I think that is what the guiding principle would be. It will not be more in terms of I would say that it would be more ownership agnostic, either private or public. I mean, the kind of risk skill set which banks have built and also the opportunities which will unfold, that will probably decide each of the banks' future trajectory in terms of the growth.
Sir, I distinctly remember when you took charge as SBI chairman, you had one mission, which is to clean up the NPAs and take ROAs higher. What is the next mission statement for Dinesh Kumar Khara?
I would say that we would like to maintain the gold standard of the asset quality in the bank, and will continue to focus on improving the customer experience, and also invest well in terms of the technology. We would also be exploring the possibilities of adoption of the generative AI, so that we can further improve the productivity of our bank and create value for all the stakeholders.
Your closing comments last time were that SBI was not getting ready for salsa, it was getting ready for tango. And it's a new year, dance parties are over now, but when will SBI do the tango?
I think we'll wait and watch.
But how do you see, sir, 2024 different from, let's say, 23 and 24 for SBI?
Well, I think in each subsequent year, we have only strengthened our position. So we have invested in terms of technology, and every subsequent year we would like to reap the benefit of our investments into technology. And also that technology helps us in improving our operations too. So this is more of a journey. Year after year is a journey, and it's a journey for improvement.
Sir, a question on what IBA has agreed, a 17% wage hike in the latest meeting. What kind of impact that will have because of A, the legacy issue, and B, the new wage hike?
Well, wage hike, etc., is a reality in which all of us have to operate, and that's why it is always our effort and endeavor to keep on improving our earnings, so that we can easily address these kind of obligations which will be there, which is actually a reality for us. But as far as we are concerned, we had started providing for it from November 22 onwards, and whatever is a gap or the difference, we will be providing to take care of that. We are very well provided as far as our obligations relating to such wage hike is concerned.
Before we wrap, one of the most underappreciated number of SBI has been the attrition rate. I look at the balance sheet of some of your private peers, I'm not getting into names, the number is at 40-50%. For SBI, the number is very admirable. What is the number for SBI? I mean, we never talk about this number, we should talk about it more.
It's actually in the much lower single digit.
SBI attrition is actually single digit, and private banks have been 50-60%, if my numbers are right.
Yeah, we are just within about in the very low single digit numbers. So that is the kind of attrition, and normally we get to see the attrition only in the early stages when people join the bank, say in the initial 5 to 7 years time. And thereafter, once those who stay on, they actually start looking at the growth opportunities within the bank. And also, it's not merely vertical growth, but it is also horizontal growth too, because they get to have opportunities to work in all the subsegments of the financial sector. And even in the banking, which is quite a complex area, they have got an opportunity to identify their area of interest and can develop into that. So we as a bank, we also invest quite a lot in terms of training our own employees. And we have 6 apex level training institute where the role is not merely, it is actually even ideation is also their role. Ideation and dissemination both are their roles. So apart from the 6 level apex level institute, we have more than 50 learning centers across the country. So we have invested well in terms of our training capabilities, and which really help us well in terms of equipping our manpower.
Really appreciate your time. Best wishes for 2024, and thank you so very much for joining us.
Thank you very much, Nikunj. All the very best. May it be very happy, healthy, prosperous year for you and ETTV. Thank you.
Thank you very much, sir. All right, now doesn't get bigger than this. I mean, we pretty much got a view from S. Naren. What is the asset allocation? And he said, "Sasta kuch nahi hai market mein." And see, I mean, look at SBI's balance sheet. On that balance sheet, if you're looking at 15-16% credit growth, and the second half is going to be better than first half, then we are in for a good credit cycle. Second, he didn't sound very worried about what the RBI new prescription is in terms of unsecured loan. He said, "I don't have problems. Others have it. That is not my bit." See, I think he's not spelling out the numbers, but if you read in between the lines here, literally you can read and hear in between lines in this case. I don't think he needs capital for next 18 months. When you don't need capital for next 18 months, and if ROI is 1% plus, 1.2, 1.3% plus, and credit growth is going to 15-16% plus with low NPAs, और क्या चाहिए?
Yeah, and to that you have the cherry on the top that the attrition is in low single digit as well. So the book is growing at a fast pace. There's no problem in terms of talent. There's no problem in terms of asset quality, and they're well funded for future. So it doesn't get better than this. Every star is aligned for SBI for now. The stock has done rather well in the year gone by. Let's see what 2024 brings. But time now to slip into a very short break. Don't go anywhere. When we come back, actually, we listen in to the conversation that Nikunj had with Hiren Ved, because it's about the new year and everybody's looking for new stock ideas as well as sector themes. Listen in to what Hiren Ved had to say.
There is always a possibility you could have a moderate year after a good year. But if you look at the data 2003 calendar, 4, 5, 6, 7, all 5 years you had positive double-digit returns. All 5 years, right? Except for 1 year, I think, which was immediately after, I think 2003 was like a 70% kind of a year, and then you had a 8-9% positive year. And after that, it was all 25-35% year after year after year. So I think why, and I'm not saying that this will repeat, but I'm saying that this has happened in the past, right? So could you have a moderate year? Yes. Very difficult to predict. But I think you don't invest year by year. You invest with a slightly longer term horizon. And I think the future is very, very positive. So why should I raise cash? As to your question of have you changed portfolios, I think the change in leadership became quite evident last year and the year before. And as I've said before, that it looks very similar to the bull market of 2003 to 2007-8, where similar kind of sectors are leading today, right? So domestic cyclicals, auto ancillary, cap goods, manufacturing, cement, real estate. It looks very similar, right? Hotels, metals, right? And to that you can add defense and EMS, because in every cycle there are new players that emerge, or renewables, as whatever you would want to call it, right? But broadly in that whole bucket of manufacturing or industrial cyclicals, whatever you want to call it, is where the leadership is in this bull market. And I think that, we have to embrace and we have to recognize that change. And I think the market leadership is telling you, right? I mean, the best performing stocks have been PSUs.
Do you think the party will continue or the rally will continue
In
PSUs?
longer term, yes. Near term, I think we've seen a very parabolic rise in many of these stocks, right? So there could be over enthusiasm, euphoria, which could have set in the short run. But an entire asset class doesn't move like this until and unless there is a good reason for it to happen, because markets are not irrational. We could wish it away. PSUs have been a bad name for a long time.
The ugly ducklings have become the swans now. Let me put it this way.
Well, Mr. Modi, on the floor of the House, told everybody that don't ignore PSUs, right? So it's at our peril that we ignore it. So I think, yes, longer term, the way their balance sheets have improved, I think general policy has been quite supportive to creating value in PSUs. But again, I would not have a broad brush that just because you're a PSU. Today what's happening is that anything that is a PSU is going up, right? I mean, like, that's not going to sustain.
What do you like in PSUs? Where have you invested?
So I'll tell you where we have invested is largely our participation has been in defense.
Okay.
Right? Because that was a very clear area where, unlikely that while the private sector will also benefit from greater participation, but I think the big monopolistic players are always going to remain the big PSUs, right? So HAL, the BELs, the BDLs of the world, you're not going to be able to replace that for strategic reasons. It's not going to happen. So I think that's, to my mind, where we've participated the most. We do have some exposure to the renewable financiers.
PFC, RFC, both?
Yeah, in our offshore fund, we have some exposure to REC and NTPC. But I think our quant strategies have wholeheartedly participated in the entire PSU pack, right? Because, quants don't have any emotions, they don't have past biases like we have as active investors. It's very difficult to switch gears. Though on the active side, as I said, we have participated largely in defense, but our quant strategies have done phenomenally well by participating in the PSU pack.
At what would be the tipping point at which you would say that I'm going to grab my gains in PSUs? What is the matrix you would use? Would you use valuations as a matrix? Would you use the environment as a matrix? Till how long do you think this rally will continue?
Look, I think these kind of leadership doesn't get over in a year, 2 years. There may be ebbs and flows, but typically these kind of trends last multiple years, right? So I don't want to call it a top as yet. Now, as I said, there could be temporary valuation overreach that could happen. I think it's very simple. You need to not get carried away by the narratives, and you got to look at fundamentals. So I think even within, whether it's PSU or private, finally, if earnings growth and cash flow doesn't come through, then none of those market caps are going to sustain. And if they do come through, and I think broadly you could argue still that barring a few areas, PSUs relative from a valuation perspective were still cheap, right? PSU banks were cheaper. There are a lot of other PSU stocks which were relatively cheap. But I would be very careful and not, assign the bullish fervor to every and any PSU.
What were your top 3 mid-cap holdings at the beginning of 2023, and have they changed as we move from 2023 to 24?
I think amongst the mid and small caps, well, some of them have now become large caps. So, as you know, for a couple of years now, we've been bullish on the ER&D space. So, KPIT, Tata Elxsi, Dynamatic Technologies. We've been holding it for 15 years now, right? It was a micro cap, and now it's a small cap. We hope at some point in time it will become a mid cap and grow, but I think the inflection point has come. We also participated in, it's another theme that we like quite a bit, which is luxury consumption, right? So we have exposure to stocks like Ethos and KDDL, which is the parent company, which we've been holding for a while, been quite bullish on it for a while. These are still small cap stocks. I think that we continue to hold that. We don't, small cap investing is also a long-term game, right? So you really have to stay invested in many of these companies for years together. I mean, Varun Beverages was a mid cap when we invested in it. It's now become a large cap company. So we haven't changed much, if you ask me.
Have you participated in any of the recent IPOs, and have you allocated disproportionate amount of money?
No.
You've avoided all the recent IPOs.
I think we've just
even
stayed
Tata
away.
Technologies.
Huh?
Even Tata Technologies, because it's a play on Tata and technology, and it is like a bada bhai of KPIT, if I put it so, openly.
No, we did not, because again there was too much euphoria, right? After a long time, you had an IPO come from the Tata stable. And for us, we were happy because we had exposure to Tata Elxsi, which, by the way, I feel is a far superior business. Both KPIT and Elxsi are superior businesses to Tata Technologies. Not to take away anything from the potential of Tata Technologies or the quality of the business, but I think, the margins tell you the story, the growth tells you the story, right? But I think over time, people will realize that KPIT and Elxsi are far superior companies than Tata Technologies is.
Hiren, one of the very basic approach any investor has now is that you look at P multiple. There are websites which give you both trailing and forward P multiple. Some of the mid-cap stocks you own, they cannot be called as cheap stocks. For example, whether it is KPIT or whether it is Ethos or whether it is Dynamatic Technologies, P multiples are north of 30 times, 40 times, even 50 times, depending on the estimate in the company you're looking at. But you are not in a hurry to sell. So when you look at long-term investing, how much importance do you give to this very basic, thumb rule of P multiples?
See, Nikunj, I think the lessons we've learned is that PE multiple is one way to look at valuations, right? Especially when you're investing in smaller companies, you need to look at the absolute market cap and the absolute profit and the size of the business today versus what you believe it could be, right? Now, it's very different in a large cap company where you can't expect profits to double, triple and go up 5x. But it could happen in a small company where optically for current year or next year or maybe the year after that, it could look at 30, 40, 50 P multiples.
Give us an example so that our viewers can relate to that. You said, okay, P multiples were expensive, but you ignored it and your conviction has rewarded you.
No, again, I don't want to give names, but
just we are discussing a case here.
I'm saying let's take an example. If a company has today, let's say 50 crores of absolute profits.
Okay.
And let's say it's trading at 50 times.
Okay.
Right? But if the business is at an inflection point and if you believe that, let's say in the next 3-4 years, the 50 crore profits could become 200 crores, 3x or 4x. what value is that 30 or 40 multiple, right? But very different vis-a-vis, let's say, a company which has profits which is, let's say, 5,000 crores and can't go to 15,000 crores in 5 years because of the base effect, right? And there, if you're paying very high multiples, one has to be careful. So, size and scale at which you look at multiples also matters. So, while the multiple itself tells you something, and yes, you know, one has to be very cognizant, but you can, I'm saying that you can ignore these multiples if you believe that profits can go in multiples of where they are today. And I think that is very important. But I agree with you that, you know, things aren't cheap, very difficult to find stocks. You typically tend to find value only once you've hit a crisis, is when you really get things cheap. Right now, very difficult.
That was Hiren Vedan conversation with Nikunj Dalmia. But let's move on. And actually, ET Now and ET Now Swadesh, in line with helping Indians rise with India, have partnered with Sundaram Mutual to launch Nivesh Day, a groundbreaking campaign to help viewers build their personal finance portfolios through regular and disciplined investing. Nivesh Day is being celebrated on the 5th of every month. Join ET Now Swadesh and Sundaram Mutual to learn how you can build your financial future with an SIP in mutual funds. Okay, on that note, let's just slip into a very short break. We'll be back with more updates after the break.